John has $1 million saved, and surprisingly, he still feels unsure about his future. He's proud of the milestone, but he knows $1 million today won't feel like $1 million tomorrow, and he wants to see who wins, time or inflation. In this video, we'll put that to the test using 5 of Fidelity's most popular index funds. You'll see how each fund behaves, what drives its growth, and how big the balance becomes at 10, 20, and 30 years. And in the end, I'll show you the one fund that pushes John's portfolio to a $90 million valuation. But before we get to the countdown, here's the simple setup behind John's experiment. John keeps this simple. He invests $1 million once, reinvests every dividend, adds nothing else, and lets time decide the results. To see how far that money can actually grow, he lines up 5 Fidelity index funds, each built differently, each compounding at its own speed. All we're doing is comparing them in a countdown, moving from strong performers to the absolute standout. So with that in place, John's experiment officially begins with the most popular Fidelity index fund, the Fidelity 500 index fund. FXAIX is John's slowest grower in this lineup, but slow is definitely relative here. This fund sets the benchmark for the coming funds as it tracks the S&P 500, which is simply the 500 largest companies in America. When John owns FXAIX, he owns a slice of nearly every major industry: technology, healthcare, finance, retail, energy, and more. It's a collection of businesses that most people interact with every single day, whether they notice it or not. And the beauty of the S&P 500 is that it constantly refreshes itself. When a company becomes stronger, it naturally takes up more space in the index. When one falls behind, its weight shrinks. Success is rewarded automatically. Because of that built-in structure, FXAIX doesn't need managers guessing which stock will win next. It just mirrors the U.S. economy's biggest companies and lets time do the heavy lifting. That's why this fund tends to deliver consistent, steady growth without the wild swings that you see in more aggressive funds. For an investor like John, that means a smooth, compounding path that climbs year after year, even if it doesn't break any speed records in the long run. Looking at the numbers, FXAIX keeps things balanced. The dividend yield sits around 1.12%. And while that's not huge, the companies inside the index raise their payouts over time, giving it a dividend growth rate of about 3.32%. The real driver, though, is share price appreciation. Historically, FXAIX has grown at roughly 12.6% a year, which is stronger than most people expect when they hear broad market fund. So what does it look like for John's $1 million? After the first year, his account would land at around $1,137,200. By year 10, the balance grows to about $3,501,490. At year 20, the steady climb becomes a lot more noticeable, reaching roughly $11,764,188. And at the 30-year mark, FXAIX pushes his investment to around $38,911,206. By then, the portfolio is generating about $22,955 a year in dividends, or around $1,913 every month. Out of that total growth, about $37,409,381 comes purely from capital appreciation, while $501,825 comes from reinvested dividends, bringing the total value added to $37,911,206. Now, John wants to see what happens when he broadens the scope beyond the top 500 companies. That brings him to number 4 on the list, the Fidelity Zero Total Market Index Fund. While FXAIX focuses strictly on the 500 largest companies, FZROX spreads its reach across the entire U.S. market. That means John owns the giants everyone knows, but he also owns mid-sized businesses that are expanding and smaller companies trying to become the next big name. It's a wider net, and that extra coverage helps capture more pockets of growth as different parts of the market take turns leading the way. Another thing working for FZROX's favor is cost, or in this case, the lack of it. The fund charges absolutely nothing in fees. A true zero-expense ratio fund. For John, that means every bit of growth that the market delivers stays in his account instead of being skimmed off each year. It's a small difference in the moment, but over decades, even tiny fee reductions can widen the gap. When you combine a wider market reach with zero cost, you get a compounding engine that edges ahead of more traditional index funds. On the metric side, FZROX carries a dividend yield of about 0.99%. The companies inside haven't been shy about raising payouts either, giving the fund a dividend growth rate of about 7.55%. The real strength, though, is in price appreciation. Historically, the fund's underlying index has climbed at roughly 13.42% a year. When you plug that into a 30-year timeline, the compounding starts to feel much more powerful than it does in the early years. So what does that mean for John's $1 million? After the first year, the account would sit around $1,144,100. By year 10, it grows to roughly $3,767,964. The 20-year mark pushes the balance to about $13,771,472. And at 30 years, FZROX lands near $49,500,500, the point where long-term compounding becomes almost unbelievable. At that size, the portfolio would be generating about $74,647 annually in dividends, or around $6,221 each month. Out of the total growth, roughly $47,514,262 comes from capital appreciation, while $986,238 comes from reinvested dividends, giving John a total value added of $48,500,500. Compared to FXAIX, that's an extra $10.5 million in growth, just by widening the portfolio from the top 500 companies to the entire U.S. market. Next, I'll show you an index fund that pays over $50,000 a month in dividend income, and in the end, you'll see the one fund that pushes John's portfolio all the way to a $90 million valuation. At number 3, John has the Fidelity U.S. Sustainability Index Fund. FITLX is where John starts to feel the curve of compounding tilt upward. This fund doesn't track the entire market or just the largest companies. Instead, it screens for U.S. businesses that meet specific sustainability standards, environmental responsibility, social impact, and transparent governance. But this isn't about politics or checking boxes. In practice, the screen pushes the portfolio toward companies that tend to be more modern, more growth-oriented, and more forward-looking in how they operate. That means tech, software, clean mobility, cloud infrastructure, and innovative consumer brands naturally rise to the top. These companies usually reinvest heavily in themselves, scale faster, and expand into new markets more aggressively. The fund doesn't try to guess which names will explode. It simply applies its rules and lets the eligible companies rise or fall based on pure market performance. For John, that means FITLX behaves like a filtered version of the U.S. growth engine, focusing on businesses that have momentum and long-term expansion built into their DNA. Metric-wise, FITLX looks different from the first two funds. The dividend yield sits around 1.1%, which is modest. But what jumps out is the dividend growth rate, an extremely strong 13.74%. That means the companies inside this index have been raising their payouts at a pace far beyond traditional dividend payers. The share price appreciation tells the same story, averaging 13.41% annually. It's a combination that delivers both on growth and dividends. So how does that shape John's future? After year 1, his $1 million would sit near $1,145,100. By year 10, the balance climbs to roughly $3,882,032. Year 20 is where things start feeling different, reaching around $15,119,451, and by year 30, FITLX stretches the portfolio to an incredible $59,085,080. The dividend profile at that point becomes a story in itself, roughly $623,882 per year, or about $51,990 every single month. Out of the total growth, about $53,367,242 comes from capital gains, while $4,717,838 comes from reinvested dividends, giving John a total value added of $58,085,080. Compared to the total market fund, FITLX adds nearly $10 million more over 30 years. And when you stack it next to FXAIX, the S&P 500 fund, FITLX outperforms it by almost $20 million. That jump comes from one thing: focusing on companies with faster, more consistent long-term growth. But John isn't done yet. He still wants to see what happens when the spotlight shifts fully onto America's biggest and most established giants. That brings him to number 2, the Fidelity Zero Large Cap Index Fund. This fund focuses specifically on large cap companies, the giants of the U.S. market that already have established products, global reach, and the financial muscle to keep expanding. These are the businesses that shape entire industries: tech leaders, medical innovators, financial powerhouses, consumer brands with worldwide influence, and industrial companies that quietly move the economy forward behind the scenes. When John owns FNILX, he owns the companies that dominate whatever space they operate in. What sets it apart from the other funds he's seen so far is the purity of its focus. The S&P 500 fund covers many of the same giants, but it mixes in more middle-of-the-pack companies because it tracks a fixed list of 500 names. The total market fund goes even wider, pulling in thousands of mid-cap and small-cap stocks, which adds more variety but also slightly dilutes the influence of the biggest winners. And the Sustainability Fund also includes large caps, but it screens them through specific criteria, which changes the mix and leans it more toward growth-oriented companies that meet those specific standards. FNILX avoids all of that. It's a straightforward bet on the largest companies in the country, giving them the full weight they naturally earn without filters, screens, or smaller names sharing the spotlight. What makes this fund especially interesting is how it blends size with efficiency. Large caps grow more steadily than small companies, but they also have the resources to push through downturns, launch new products, acquire competitors, and invest heavily in innovation. This gives FNILX a very consistent upward trajectory. And because this is part of Fidelity's zero lineup, the expense ratio is 0. John pays absolutely nothing in management fees, not a dollar, not a cent. Every bit of growth lands directly in his account, which quietly boosts compounding over the long run. Looking at the metrics, FNILX sits at a dividend yield of about 0.93%, which isn't high, but it's backed by an impressive 11.72% dividend growth rate. That combination means companies inside this index are distributing more to shareholders each year while still investing in future expansion. As for its price appreciation, FNILX has averaged about 14.31% annually, which puts it noticeably ahead of the broader market and the sustainability fund John just reviewed. So what does all that translate to for John's $1 million? Well, after 1 year, his balance would be about $1,152,400. By year 10, the account grows to roughly $4,094,634, already passing the $4 million mark. At 20 years, the portfolio climbs to around $16,489,567, showing how fast the curve steepens once compounding fully kicks in. But it's the 30-year mark that makes this fund truly stand out. FNILX takes John's investment to roughly $65,560,312, a number that's hard to even picture until you break it down. At that size, the portfolio would generate about $248,253 in annual dividends, or roughly $20,688 every single month. Out of the total gain, around $62,301,199 comes from share price appreciation alone, while $2,259,113 comes from reinvested dividends, adding up to a total value added of $64,560,312. That puts FNILX more than $6 million ahead of the Sustainability Fund, over $16 million ahead of the Total Market Fund, and nearly $27 million ahead of the S&P 500 fund. For a portfolio made entirely of America's largest companies, that kind of lead is massive, but it still isn't the fastest compounding engine on John's list. The final fund takes everything he's seen and pushes it into a completely different league. And that is the Fidelity NASDAQ Composite Index Fund. So this fund tracks the NASDAQ Composite, an index built around technology, communication services, and innovation-driven companies. In simple terms, John isn't investing in slow movers here. He's buying into businesses that are rewriting how the world works. Software, semiconductors, artificial intelligence, cloud services, e-commerce, robotics, digital advertising, biotech breakthroughs. The companies reshaping modern life live here. And unlike the S&P 500, which caps its exposure at 500 holdings, the NASDAQ Composite includes thousands of companies. Some are massive, like Apple, Microsoft, Nvidia, Amazon, and Meta. Others are up-and-coming firms trying to become the next big win. That mix of giants plus hungry newcomers gives FNCMX an explosive growth personality. It doesn't grow in a straight line. It goes up, it dips, and then it goes up again, often harder than before. The ride, yes, can be bumpy, but over long periods, the innovation economy has a track record of pushing higher faster than almost any other segment of the market. On the metric side, FNCMX is very different. The dividend yield is low at 0.5% because most companies in this index prefer reinvesting into products and rapid expansion instead of paying high dividends. Dividend growth has been slightly negative at negative 4.88%, which simply reflects how tech firms often prioritize growth over those payouts. But none of that matters when you see the share price appreciation. FNCMX has averaged a staggering 16.12% annually, the fastest in John's entire lineup by far. So what does that pace look like over the long run? Well, after 1 year, John's $1 million grows to about $1,166,200. By year 10, the balance climbs to roughly $4,540,685. At year 20, the numbers jump dramatically to around $20,274,722, which means John's investment has already multiplied more than 20-fold. But the 30-year mark is where FNCMX separates itself from everything else in this countdown. By year 30, John's portfolio reaches roughly $90,385,226, a number so large it almost feels like a typo the first time you see it. The dividend output at this level is tiny compared to the balance, about $418 a year or $35 a month, but that's only because nearly all the growth came from price appreciation. Out of the total value added, roughly $89,328,498 comes from appreciation alone, while $56,728 comes from reinvested dividends, giving John a total gain of $89,385,226. These numbers are unbelievable, but the reality is simple. Not everyone starts with $1 million. The good news is you don't need to. If you want to see how to build a portfolio that pays over $8,000 a month in dividends with just $5 a day, click the video on the screen for a step-by-step guide.